IAS 38 Intangible Assets establishes the accounting principles for recognizing, measuring, and reporting non-physical assets that provide future economic benefits to an entity. Within the DIP-IFR syllabus, intangible assets and goodwill are important because they often represent significant sources of organizational value in modern economies driven by technology, innovation, and intellectual property. Intangible assets include items such as patents, trademarks, software, copyrights, customer relationships, and licenses. Goodwill, however, arises specifically through business combinations when the purchase consideration exceeds the fair value of identifiable net assets acquired. IAS 38 aims to ensure that intangible assets are recognized only when reliable measurement and probable future economic benefits exist. Proper application improves transparency, comparability, and faithful representation within financial statements. A major distinction within IFRS accounting standards exists between purchased goodwill and internally generated goodwill. Purchased goodwill arises during a business acquisition when the acquirer pays more than the fair value of identifiable net assets because of expected synergies, brand reputation, customer loyalty, or future profitability. Purchased goodwill is recognized as an asset in consolidated financial statements. Internally generated goodwill, however, cannot be recognized because it cannot be measured reliably or separated from the overall business. Factors such as employee expertise, internally developed reputation, or market position may contribute significantly to enterprise value but fail to meet recognition criteria. This distinction prevents excessive subjectivity and protects financial statements from unreliable valuations that could mislead investors and stakeholders. Goodwill differs fundamentally from other intangible assets because it is not individually identifiable or separable from the business as a whole. Other intangible assets are identifiable non-monetary assets without physical substance that can either be separated and sold independently or arise from contractual or legal rights. Examples include patents, trademarks, software, and licenses. Unlike goodwill, identifiable intangible assets can often be measured reliably and may have finite or indefinite useful lives. Finite life intangible assets are amortized systematically over their useful lives, while indefinite life intangible assets are not amortized but tested annually for impairment. This distinction is important because it affects recognition, measurement, amortization, impairment testing, and presentation within financial statements prepared under IFRS accounting standards. IAS 38 establishes strict recognition criteria for intangible assets to ensure reliability and consistency in financial reporting. An intangible asset is recognized only when future economic benefits are probable and the asset's cost can be measured reliably. Initial measurement is generally based on cost, including purchase price, directly attributable costs, and expenditures necessary to prepare the asset for intended use. Internally generated intangible assets require special consideration because many internally incurred expenditures fail to meet recognition requirements. Research costs must always be expensed because future benefits remain uncertain at that stage. Development costs, however, may be capitalized if specific conditions are satisfied, including technical feasibility, intention to complete the asset, and reliable cost measurement. This approach balances relevance with prudence in financial reporting. Purchased goodwill is not amortized under IFRS accounting standards, but is instead tested annually for impairment under IAS 36 Impairment of Assets. Goodwill acquired through business combinations is allocated to cash-generating units expected to benefit from acquisition synergies. Entities must compare the carrying amount of the cash-generating unit, including goodwill, with its recoverable amount. If carrying amount exceeds recoverable amount, an impairment loss is recognized immediately in profit or loss. Importantly, impairment losses relating to goodwill cannot be reversed in future periods, even if economic conditions improve. Annual impairment testing ensures that goodwill values remain realistic and prevents overstatement of acquired business value within consolidated financial statements. This requirement strengthens transparency and enhances investor confidence in reported asset values. A gain on a bargain purchase arises when the fair value of identifiable net assets acquired exceeds the consideration transferred in a business combination. Such situations may occur during distressed sales, forced transactions, or exceptional negotiations where the acquirer obtains assets below fair value. Before recognizing a gain, IFRS accounting standards require entities to reassess all measurements carefully to ensure accuracy of asset valuations, liabilities, and consideration transferred. Once confirmed, the excess amount is recognized immediately in profit or loss as a gain on bargain purchase. This treatment differs significantly from goodwill recognition because it reflects an economic benefit obtained through favorable acquisition terms rather than anticipated future synergies. Proper accounting for bargain purchases ensures faithful representation of acquisition outcomes within financial reporting. Overall, IAS 38 and related IFRS accounting standards provide a comprehensive framework for distinguishing, recognizing, measuring, and impairing intangible assets and goodwill. The standards emphasize reliability, faithful representation, and prudent recognition to prevent overstatement of non-physical assets within financial statements. Through strict recognition criteria, impairment testing requirements, and differentiation between goodwill and identifiable intangible assets, IFRS promotes transparency and comparability in global financial reporting. Understanding these principles is essential for DIP-IFR candidates because intangible assets increasingly influence organizational valuation, strategic decision-making, mergers and acquisitions, and investor analysis. Proper application of IAS 38 supports high-quality financial reporting and ensures that financial statements accurately reflect the economic benefits generated by intellectual property, innovation, and acquired business value.